A 19-year-old kid lost a briefcase on the subway. Inside, $287 million in bonds. And for 4 weeks, the entire American financial system was on the verge of total collapse. This actually happened. Let me tell you how. May 12th, 1975. A teenager named Gerald Lascari walks into his boss's office and says 4 words, "I lost the bonds." Not one bond. Bonds. Plural. $287 million worth. That's $1.6 billion in today's money. Just gone. Vanished somewhere between Wall Street and New Jersey. And here's the crazy part. Those weren't just pieces of paper representing money. They were the money. If you couldn't physically show someone the certificate, the money didn't exist. No backup copy. No digital record. No insurance company that would cover this. Wall Street in 1975 literally ran on paper, trust, and teenagers carrying briefcases full of bonds worth more than entire companies. One kid lost a briefcase, and it almost caused every major bank in America to go bankrupt. This is the story of how the entire financial system nearly collapsed because nobody could find a piece of paper, and why something like this could never happen today. Or could it? Watch what happens next. So let me paint you a picture. It's morning rush hour in Manhattan. Gerald Lascari is 19 years old. He works as a messenger for a small brokerage firm you've never heard of. His job? Take bonds from one office, deliver them to another office. Sounds simple, right? Like being a delivery driver. Except what he's carrying in his briefcase is something called bearer bonds. Bearer bonds are insane. Whoever physically holds them owns them. No questions asked. No names attached. These aren't checks made out to you. They're basically cash in certificate form. And the briefcase Gerald is carrying? $287 million worth. He's 19 years old. And he takes the subway. This was just normal. This is how Wall Street worked. Gerald gets off at his stop, walks 3 blocks. Then he looks down. The briefcase isn't in his hand anymore. He panics. Checks the subway car. Not there. Retraces his steps on the street. Nothing. So he goes back to the office and tells his boss. His boss goes completely pale. Because what just happened was the single largest financial loss in Wall Street history. And it gets so much worse. Those bonds. Not insured. At all. Insurance companies in 1975 wouldn't cover bearer bonds lost in transit because the risk was too massive. So now this small brokerage firm is on the hook for $287 million they definitely don't have. They'll be bankrupt by Wednesday. But honestly, that's not even the real problem. The real problem is way bigger. Those bonds were being moved between 2 banks as part of a settlement. Bank A sold securities. Bank B bought them. The bonds were the payment. Except now the payment has vanished into thin air, which means Bank B doesn't have the securities they paid for, and Bank A doesn't have the money they're owed. Both banks are now short, and both of these banks have hundreds of other transactions scheduled for that same day that depend on those securities existing. Each of those transactions involves other banks, who have their own transactions lined up. The entire financial system in 1975 is like a massive web of IOUs that all have to clear on the same day. If one link breaks, everything starts to cascade. And this isn't just one link breaking. This is $287 million worth of links, all gone at once. Let me explain how absolutely insane the paper-based finance system was. Every single day, thousands of messengers like Gerald walked around Manhattan carrying briefcases full of stock certificates and bonds. And these weren't just papers that represented money. They were the money. If Bank A bought stock from Bank B had to physically hand over the paper certificates. An actual human being had to walk them across town. Sometimes they used armored cars, but usually just teenagers with briefcases. The volume was ridiculous. By 1975, Wall Street was processing 30 million share trades every single day. And every single one required physical paper to move from place to place. They called this system settlement, and it was completely breaking down. Here's why. In 1960, the stock market traded about 3 million shares per day. By 1968, 20 million shares per day. The number of trades was exploding, but the system for actually settling those trades hadn't changed since 1792. It was still paper certificates in briefcases. The brokerage firms hired more and more messengers. But there's only so many people you can cram into Manhattan. By 1968, Wall Street was literally drowning in paper. Brokerage firms had back offices stacked floor to ceiling with unsettled trades. They couldn't find the certificates. They couldn't match up the paperwork. Trades were failing everywhere. So the New York Stock Exchange did something completely unprecedented. They closed the stock market every Wednesday. Not for holidays, not for maintenance, just because they needed one full day per week to catch up on paperwork. This went on for months. The American stock market, the engine of global capitalism, shut down one day per week because there was too much paper to process. And it gets worse. Between 1969 and 1970, over 100 brokerage firms went completely bankrupt. Not because they made bad investments, not because the market crashed, because they literally could not process the volume of paper. They lost track of who owned what. Clients would call demanding their certificates. The firms couldn't find them. They were buried somewhere in a warehouse under 10 million other pieces of paper. So the firms just collapsed. This wasn't about the economy. This was about physics. Paper has mass. Paper takes up space. Paper can get lost. And Wall Street in 1970 was learning the hard way that you cannot scale a system built on paper past a certain point. That point was around 15 million trades per day. They were doing 30 million. So the government had to step in. Congress passed something called the Securities Investor Protection Act in 1970. They created the SIPC to ensure customer accounts when brokerages failed, kind of like FDIC, but for investment accounts. This helped a little bit, but it didn't solve the core problem. The core problem was physical settlement, moving actual paper around. The New York Stock Exchange put together a task force to study the issue, and the conclusion was obvious. Wall Street needed to go digital. Create a central place where certificates could live electronically instead of physically moving around Manhattan. Something called the Depository Trust Company, the DDC, already existed in prototype form since 1973. But most firms were still settling trades the old way. With paper, with messengers, with kids like Gerald Lascari who could lose $287 million on the subway. So it's May 12th, 1975, around 10:47 a.m. Gerald's boss calls the bank. The bank calls the other bank. The other bank calls the Federal Reserve. The Fed calls the SEC. Within 2 hours, everyone knows. $287 million in bearer bonds are just out there, somewhere. And here's the nightmare scenario. Bearer bonds are completely anonymous. Whoever holds them owns them, which means if someone found Gerald's briefcase, they could literally walk into any bank in the world, present those bonds, and get paid. No questions asked. No ID required. That's what bearer means. The bond itself holds the value, not the person holding it. It's the financial equivalent of cash. If you drop a $100 bill on the street and someone picks it up, it's theirs now. Except these are basically $100 million bills. The FBI gets involved immediately, not because there's evidence of a crime, but because if word gets out that $287 million in bearer bonds are floating around, someone might try to cash them. Every bank on the planet needs to be warned. If someone shows up with these specific bond serial numbers, freeze them. Don't pay out. The FBI sends an urgent message to every financial institution worldwide. The bond numbers get flagged. Banks everywhere are watching for them. And then everyone just waits. Because maybe whoever found the briefcase has no idea what they found. Maybe they threw it away thinking it was junk. Maybe it's sitting in a dumpster in New Jersey right now. Maybe it's in the Hudson River. The bonds were printed on waterproof paper, so if they got destroyed, the issuing companies would eventually reissue them. After 7 years. That's 7 years of $287 million in limbo. 7 years of 2 banks being short on their balance sheets. 7 years of settlement failures rippling through the entire system. Here's what happens next. The 2 banks involved go running to the Federal Reserve. They need emergency money. They're short $287 million on their balance sheets. They can't settle their other trades. The Fed opens something called the discount window and provides short-term loans. This buys them some time, but it doesn't solve the crisis. Because now other banks know that 2 major banks are in trouble, which means those banks might not be able to honor their commitments. So other banks start pulling back. They refuse trades. They demand immediate settlement. The trust network that holds the entire financial system together is starting to fracture. And all because Gerald lost a briefcase. The brokerage firm that employed Gerald is done. They declare bankruptcy within a week. Their insurance doesn't cover lost bearer bonds. Their assets get liquidated. The partners lose everything. Gerald gets fired, obviously. But here's the legal twist. He's not personally liable. He was just an employee doing his job. The firm is liable, which doesn't matter because the firm is bankrupt now. So the $287 million loss falls on the two banks, who definitely don't have $287 million sitting around to absorb a loss like that. They need the Fed to keep them alive. And the Fed does. But the Fed can't do this forever. If those bonds never turn up, the Fed is essentially printing money to cover a hole caused by a piece of paper disappearing. This is not how any of this is supposed to work. 3 weeks go by. The bonds don't surface anywhere. The FBI has zero leads. Every bank in America is on high alert. Nothing. People start to assume the worst. Maybe they're destroyed. Maybe someone found a briefcase full of official-looking papers they didn't understand and just threw them out. This actually happened before. In 1974, a janitor in Philadelphia found $3 million in bearer bonds in a bathroom. He thought they were fake, just threw them in the trash. By the time anyone realized what happened, the bonds were in a landfill somewhere. Gone forever. The issuing company had to wait 7 years to reissue them. Wall Street is quietly preparing for the same thing with Gerald's bonds. 7 years of frozen capital. 7 years of holes in balance sheets. 7 years of systemic risk just sitting there. But then June 9th happens. For weeks after Gerald lost the briefcase, the FBI gets a phone call. Anonymous tip. Someone found a briefcase in a subway station in Newark. Took it home. Opened it up. Saw a bunch of official-looking papers with huge numbers on them. Got nervous. Called the FBI. The FBI sends agents immediately. They recover the briefcase. All 287 bonds are inside, completely untouched. Whoever found it had absolutely no idea what they had. They just knew it looked important enough to return. The FBI verifies the serial numbers. They all match. The bonds are real. The bonds are intact. Just like that, the crisis is over. The two banks get their settlement. The Fed closes the discount window. The system stabilizes. Gerald Lascari disappears from history forever. And Wall Street learns absolutely nothing. Because here's what's truly insane. This happens again. September 1976. Just 16 months later, a messenger for another firm loses bonds worth $318 million. Just gone. Vanished between offices. The FBI launches another massive search. The bonds are never recovered. The firm goes bankrupt. The banks absorb the loss. The system survives. Barely. And Wall Street finally admits the obvious. You cannot run a modern financial system on paper certificates carried by teenagers. The push to digitize everything accelerates rapidly. The depository trust company becomes mandatory for all major brokerages by 1977. Certificates stop moving around. They sit in one central vault. Ownership transfers electronically. The age of paper settlement ends. Not because of innovation or smart planning, because of cascading disasters that made continuing impossible. Let me show you what actually changed. Before 1975, if you bought 100 shares of General Motors, your broker would get a physical stock certificate. That certificate would either be mailed to you or held in your account as a physical object. If you sold those shares, the certificate had to be physically delivered to the new owner. This process took days, sometimes weeks, and the whole time, the certificate was in transit. Vulnerable. After 1977, certificates stopped moving at all. When you buy 100 shares of General Motors now, no paper moves anywhere. The depository trust company just updates a digital ledger. Your brokerage account shows you own 100 shares, but there's no certificate with your name on it anywhere. The certificate sits in a vault at the DTC. All trades are just electronic updates to a ledger. Settlement went from 5 days down to 3 days. By 2024, settlement happens the same day. No paper, no messengers, no lost briefcases. But here's the trade-off nobody talks about. The old system was inefficient, dangerous, and constantly breaking. But it was distributed. Certificates existed in thousands of different locations. If one building burned down, you'd lose those specific certificates. That's tragic, but it's contained. The new system is efficient, safe, and scalable, but it's completely centralized. Every stock certificate in America sits in one building, the DTC vault in downtown Manhattan. If that building were somehow destroyed, the entire stock market would face an existential crisis. Yes, there are digital backups, multiple redundant systems, disaster recovery protocols, But the physical certificates representing ownership of trillions of dollars in assets all exist in one single place. We traded distributed fragility for centralized efficiency. Most days, that's absolutely the right trade. But it is a trade. And here's the weird legacy of Gerald's lost briefcase. The SEC started using it as a case study for why bearer bonds needed to be completely phased out. Bearer bonds were always problematic. Anonymous ownership, impossible to track, perfect for money laundering, tax evasion, organized crime. But they stuck around because they were also convenient for legitimate stuff. Settlement between institutions, international trades, less paperwork. Gerald's loss, combined with the 1976 disaster, gave regulators the ammunition they needed. Congress passed the Tax Equity and Fiscal Responsibility Act in 1982. Section 310 basically banned new bearer bonds completely. All bonds issued after 1982 had to be registered, meaning they have a named owner on record. You can't just hand them to someone else anymore. If they get lost, they can be reissued to the rightful owner. Bearer bonds didn't disappear overnight. The ones issued before 1982 are still valid. Some are still in circulation today, but no new ones can be created. Gerald's briefcase killed an entire category of financial instrument. Now let me connect this to your actual life. You probably think your money is safe because it's digital now, and it is, mostly. But the system still has paper-based weak points. Your house deed? Paper document. Your car title? Paper document. Your stock certificates used to be paper, now they're digital entries in a centralized database. But what if that database got corrupted? What if a massive cyber attack wiped the ledger? The DDC has backups, multiple layers of them. But so did the paper system, technically. The paper system had the actual physical certificates as the backup. The digital system has other digital copies as backup. It's resilient. Until it's not. We haven't had a Gerald Lascari moment in the digital age yet. But the digital equivalent would be so much worse. Gerald lost $287 million. A major database corruption could lose trillions. And unlike a briefcase, you can't just find it sitting in a Newark subway station. Here's the uncomfortable truth. The 1975 crisis happened because the system scaled past its design limits. Paper couldn't handle 30 million trades per day, so we switched to digital. And digital handles billions of trades per day without breaking a sweat. But every system has limits. Digital systems just have different failure modes. Not lost briefcases, cyber attacks, software bugs, cascading algorithmic errors. The flash crash of 2010 erased $1 trillion in market value in just 5 minutes because of algorithmic trading glitches. The money came back, but for 5 minutes, it was just gone, vanished, just like Gerald's briefcase. Except this time, it wasn't a 19-year-old losing a briefcase. It was computers talking to other computers too fast for humans to even intervene. We solved the paper problem. We created a whole new problem. And here's what the experts won't tell you. The financial system is always one disaster away from total collapse. Always. In 1975, it was lost bonds. In 1987, it was program trading. In 1998, it was long-term capital management. In 2008, it was mortgage-backed securities. In 2020, it was a liquidity freeze during COVID. Every decade, something breaks. Something nobody predicted. And every single time, the system survives because the Federal Reserve provides emergency liquidity. The Fed is the ultimate backstop, the lender of last resort. When Gerald's bonds went missing, the Fed opened the discount window. When Lehman Brothers collapsed in 2008, the Fed provided trillions in emergency loans. The system works until it doesn't. And when it doesn't, the Fed just prints money to hold everything together. This has worked for 50 years. It'll keep working until one day it doesn't. So what happened to Gerald? He basically vanished from history. No interviews, no memoirs, no public apologies. He was 19 years old. He made a mistake that could have collapsed American finance. And then he just disappeared. The firm that employed him went bankrupt. The partners sued each other. The lawyers made millions. Gerald walked away. He probably changed his name. Probably never told anyone what he did. Can you even imagine? You're 19 years old. You lose a briefcase. And for 4 weeks, the entire financial system of the United States is teetering on the edge of collapse because of you. The FBI is searching for your briefcase. The Federal Reserve is providing emergency liquidity. Two major banks are on the verge of going under, and then someone finds it and returns it. The crisis just ends, and you're supposed to go back to your normal life? Except you can't, because everyone knows who you are. Your name is in every financial newspaper in America. You're the kid who almost bankrupted the country. So you disappear. The two banks that nearly collapsed, they survived, got absorbed into larger banks during the merger wave of the 1980s. The brokerage firm that employed Gerald liquidated, ceased to exist. The bonds themselves eventually redeemed years later when they matured. The companies that originally issued them never even knew their bonds were lost for 4 weeks. From their perspective, nothing unusual happened. The bonds were issued, held by investors, and eventually paid back with interest. The near collapse of the entire financial system was completely invisible to them. That's how fragile this whole thing is. A crisis can be raging in the settlement infrastructure, and the actual economy doesn't even notice. Until it does. Here's the final irony. Gerald's lost briefcase forced Wall Street to modernize. The depository trust company went from being optional to being mandatory because of disasters like this. Settlement went from paper to digital. The system became way more resilient. And it happened because a 19-year-old made a mistake. Not because regulators carefully planned it. Not because Wall Street wanted to change. Because the old system broke so catastrophically that continuing was literally impossible. Crisis drives change. Always. The financial system only modernizes when it's forced to. 1975 forced it. 2008 forced it again with Dodd-Frank regulations. The next crisis will force the next wave of changes. We just don't know what that crisis will look like yet, but we know it's coming. Because the system is always fragile, always complex, always one unexpected disaster away from complete chaos. In 1975, it was a lost briefcase. In 2008, it was subprime mortgages. In 2035, it might be quantum computing breaking all our encryption, or a solar flare frying server farms, or a cyber attack erasing ledgers. We don't know what it'll be, but history tells us something will break. And when it does, the Federal Reserve will step in, print money, provide liquidity, hold the system together, just like they did when Gerald lost his briefcase. The system survives. It always survives, until the day it doesn't. Gerald Lascari walked into his boss's office and said, "I lost the bonds." For words, $287 million. For weeks of crisis. One anonymous hero who found the briefcase and returned it. And an entire financial system that learned it couldn't trust paper anymore. The age of bearer bonds ended. The age of digital settlement began. All because a teenager lost a briefcase on the subway. The fragility is still there. The next crisis is still coming. We just moved it from paper to pixels. And we're all praying we build enough redundancy to survive whatever breaks next. If you enjoyed this video, make sure to subscribe and hit that notification bell. Drop a comment below with your thoughts on government control of currency. And check out my next video where I dive into another insane story you won't believe. See you there.